Welcome to today's presentation, Navigating the Next Chapter, Estate Tax Mitigation and Wealth Preservation Strategies for Exiting Australia and US Entrepreneurs, those dual tax resident type entrepreneurs. I'm Ashley Murphy, the founder and principal of Areté Wealth Strategists. Let's get into it. So, of course, today's presentation, like all of my publicly available presentations, does not constitute personal financial tax or investment advice. If you are a client of mine, then that is what we are in the business of doing. And if you are not, this is for general educational purposes only. I should mention we have a YouTube channel. If these topics are of interest to you, then I would encourage you to subscribe. Subscriber numbers have grown substantially, albeit off a low base, but nevertheless, they're picking up now in getting into the hundreds of subscribers. I should mention there's probably about 50 presentations on all manner of niche topics affecting Australians in America and Americans in Australia, and those planning their financial lives between the two countries, including last month's widely viewed presentation here on navigating the Trump tariff storm. It seems like we're in the eye of that storm right now, where a 90-day pause has been put on those tariff discussions. We'll see what eventuates from all of that. A little bit about me. So I am a tri-citizen. So I was kind of born into this whole cross-border financial world, grew up in Brisbane, lived in the US for 20 years, and now my situation is one where I really do live between the two countries. We spend 3 months a year in the US and 9 months of the year back in Australia. I've been associated with financial planning and investing now for the past 15 years, and have been the principal of Areté Wealth Strategists for the past dozen years. I also founded the Global Financial Planning Institute, where we have many dozens of members who come to learn about principles of working across borders and all the different things that are involved with that. Okay, kind of clients Areté Wealth Strategists work with. You see here, we've got the example of the business owner living between the two countries, the high net worth family currently living in the US and looking to pack up and move back, and the Australian executive family who has permanently relocated to the US. So we're doing all sorts of things for these clients, but primarily putting together a financial plan to maximize their outcomes and avoid mistakes in their planning, and as well help with their investments. We have access now to an incredible variety of investment options, including private investments that I have mentioned to clients previously. All right, so today's presentation, we're looking at 3 major sections here. The first is tax planning, the next is estate tax mitigation, and lastly, wealth preservation techniques. I should mention, this is really for the client who has an issue to do with estate tax problems. Who is going to face estate tax problems? At least today, with how the laws are written, that would be an individual with an estate worth 13.99 million. What is an estate quote? That is your net worth. That is everything you've got everywhere that either you own directly or you have signature authority over. So we'll be talking about many factors associated with the planning for such individuals. So let's get into it. Tax planning. Just an update here on where we are, where the Trump administration is, and the House and Senate are on extending the TCJA, the Tax Cuts and Jobs Act of 2017. Really, the majority of their effort is on extending this particular package. So we're seeing lower marginal rates as compared with pre-2017, that is, with the top rate being 37%. So many things are said by Trump that it's hard to know, how much weight to put to anything. There was talk as recently as last week that he would raise that top marginal rate back to 39.6%. Currently it's 37, and that's how the TCJA is written. What the TCJA did also was to double the standard deduction, which meant that many fewer people qualified for itemized deductions, which is one of the few things that would have made tax returns a little simpler. There's also a push to maintain this 21% corporate tax rate and extend this 20% qualified business income deduction, which is known as 199A, critical for small businesses, but subject to wage capital limits. That's $400,000. If you are not in a covered enterprise. What are those covered enterprises? Typically to do with manufacturing. So really trying to bring manufacturing back to the US, and we see it here in the tax code. New temporary measures would be the SALT cap. That has nothing to do with that table condiment. That refers to state and local taxes. So there was some controversy when this came in. It really hit those higher real estate value states, which coincidentally happened to be Democratic leaning, very hard. And so that was California and New York in particular, where by limiting the SALT limit to $10,000, it meant suddenly people in those states had a lot more tax to pay. Now the proposal is to increase that up to $30,000, but make it income index. So again, you're making over $400,000, you might find yourself phased out of that one. One from the campaign trail that does seem to have actually made it into the proposals here is exempting overtime pay and tips. However, interestingly, that one is scheduled to sunset after a period of time. So, you could say it's holding true to the campaign proposal, but only for a limited period. I wonder what effect also the overtime pay will have. It would seem like everyone's going to try and rush out and minimize their scheduled hours and maximize their overtime pay. That would seem like a pretty easy strategy. So suddenly full-time workers are going to get reclassified as part-time, so that overtime is tax exempt. Wouldn't seem to provide a disadvantage to an employer, presuming there's no penalty rates for overtime. It would seem to disadvantage the government. And that's a big problem that we see with this whole proposal here, and I'm sure everyone else has heard it on the media, and that is that we're really beginning to get over our skis in the US with the amount of tax revenue that's coming in versus the amount of expenditure that's going out. We've got unfunded deficits. I tell you, not a day goes by that I don't read in one of the many financial journals that I subscribe to that there's concern about the US retaining primacy as the world's reserve currency. Just last week, we saw Moody's downgrade the US credit rating from AAA to AA. So it seems like the kind of thing that happens suddenly, and then all at once, the credit might not be there in the event of the next emergency. Last point here, auto loan interest deduction, which is interesting. I haven't actually seen much talk about that. Limited to US assembled vehicles, $10,000 cap. Now that's not $10,000 on the purchase price, that's on the interest amount. Phases out above a lower level of income, as you see. Okay, we're moving on to talk about state-specific residency planning. This is actually a topic I have not addressed before, and I would say the applicable audience for the next few slides are individuals who are thinking perhaps of going to the US for a quote-unquote tour of duty, or are in the US already and really beginning to plan their exit and thinking, how do I do this in a manner that's really going to maximize my take home, my net benefit from my time in the US. So first thing to know is US tax residency is typically determined by where you live and work for most of the year. The definitions vary. You've got states that charge a state income tax that classify individuals by domicile. Domicile is a much stickier definition, and it is not good for the globally mobile individual. Why? If you are a tax resident of California, let's say, and you own a house or something like this, and you go to Europe or go back to Australia to work for a couple of years, you feel good that there's a tax treaty, you won't end up paying double taxes. That much is true at the federal level, but not at the state level. So some of the worst outcomes we see are folks that are considered California or New York tax residents that end up moving overseas. They work and they continue to have to pay state taxes back in their resident state. What might you do to address that? Well, let's say it would be, some extensive planning. I will give you that, but it would mean taking the steps to sever that state residency before moving overseas. That may well mean selling your house. It may mean taking some pretty substantial moves, because that, depending on the sort of income you're expecting to earn overseas or from your investments, that really could be quite substantial. Other definitions used is statutory residency, so such as New Jersey, Philadelphia, Connecticut, Massachusetts, or Ohio. And that's say if you just spend a certain number of days in that state, 183 days typically, then you're going to be a resident of that state. That's a better definition for someone who's globally mobile, because they may not pass that day count, in which case they wouldn't be considered a tax resident. That was my case back in Minnesota throughout 2020, certainly 2021, because I was only there for less than a month. But 2022 is the tax year in particular, and 23 for that matter, where that came in for me, where I'd spent less than 6 months in the state. And so there was this proration of my state income tax liability that came up because of that. Thank goodness for that, that definition. So states, as it happens, actually have these things called reciprocity agreements. You could think of them like mini tax treaties. This way, U.S. citizens, or U.S. tax residents is a better term, U.S. tax residents don't end up being full-year tax residents in multiple states and having, say, New York and California state tax apply to their entire income. So that is just something to be aware of. So this won't be any news, I don't think, to anyone here on today's call, but the highest marginal rate states we see are California there, coming in at 13.3%. However, no state or local taxes, no city or local taxes in California, but it does hit a fairly high state rate right there, 13.3. Then we've got Jersey, New York, Hawaii, and Oregon. Now, New York is a stinker because there's actually a city tax applied in the state of New York, in the city of New York, which, as I discovered, includes the boroughs as well. So you've got to be jumping on that train, heading way out into the boonies to escape that, which I've always found to be a fascinating loophole, basically, for avoiding the New York state tax that we'll see right here, 3.876%. So you could think of it, that's paying for your train fare to get out to Connecticut. And maybe that's why we saw in that show Mad Men that old Don Draper would take the train to get back out to the burbs. Someone who's maybe more familiar with the geography there could correct me there, but it seems like that's kind of what they were saying was going on in that situation. So what do we have? Top marginal rate of these states, you see Texas, Florida, and Washington. Well, they have no state income tax, but Washington, I believe it was last year or 2023, they introduced this capital gains tax for folks making more than $250,000. So that's never welcome additional taxes. But here's the thing to know is that when thinking about it at a societal level, you really do see a difference in standards in these states with no income taxes. The other thing to say is that so there's fewer state services, but there's also a limit to how little they can provide. So where I'm going with that is in states with no income tax, you might see inheritance taxes, you might see higher property taxes, you might see higher sales taxes. So other kinds of taxes, their coffers are getting full in some way, they just may not be doing it with income taxes. I think the real tax mavens are the people that live just over the border to a higher income tax state, and thus are able to enjoy the benefits of both places. So this slide I put together, really thinking of that individual that might be planning their US move. How might they do it to maximize their time and, well, their income? Time is money, right? Maximize their income in the US. So they would probably move to a no state income tax state, mindful of Washington there with that 7% capital gains rate. They might choose to set up in one of those states and take a job there. As I mentioned, here's the further detail on New York, and I mean, a very low limit. It's that dirty trick also that the Australia employs with not indexing those income amounts. So when this was initially set up, it was, only those high income earners making above $50,000 have to worry about that highest marginal rate. Now it's the clerks in the department store as well that are caught by this 3.876%. So New York and California can see some pretty nasty taxes when you combine that highest federal rate of 37% with 14%. You're talking about rates that are actually higher than Australia, given that the highest rate, including Medicare levy in Australia, is around 48%. So, but no one's going to shed a tear, I'm sure. For high income, making more than $1 million, and that's the kind of rate, US dollars. That's the kind of rate that you'd be paying. All right, let's move on to estate tax mitigation. This, like I said, this is kind of advanced here, so stay with me as I try and break down these concepts. So for income tax, we see a definition of residency that is different to estate and gift taxes. Estate and gift taxes, they use this term transfer tax. Transfer tax is this cover-all term that covers gift and estate tax. Why do they call it a transfer tax? Because when you think about it, it's really quite simple. You're transferring assets or wealth from one person to another. You're either doing it while you're alive, which is a gift, or you're doing it at death, which is going to be on the estate side. Income tax definitions of residency, typically based on physical presence. Don't forget the US also has this nasty citizenship based. It's not strictly citizenship based, but if you're a green card holder or a US citizen, doesn't matter where you are in the world, and I've done many presentations on this topic. No matter where you are in the world, you're still a US tax resident. We are supporting this residency-based taxation bill that we're hoping sees the light of day this year, and that would grant non-US, how do we phrase this? For Americans, tax residents outside of the United States, it would mean they would not be taxed on their non-US sourced income. So that being whatever money they're making that's not happening in the US, that would not be taxed by the US. That would be a wonderful thing to see. Contact your local representative to get support behind that bill, because it would solve many problems for many millions of Americans abroad. Okay, estate and gift tax definition is different. They use this word domicile, and forevermore, your ears will probably prick up when you hear someone use the word tax resident. Whoa, what do you mean tax resident? Do you mean for income tax purposes or for transfer tax purposes? Because that definition is different. As we see above, for income tax purposes, 183 days, or if you're a US citizen or green card holder, you're always going to be one. But domicile is different, where that is where you see yourself permanently, where you're in my case, it's easy to bring up this example because I just went through this myself. So we moved to the US, we moved from the US in 2021 to Australia. We rode out COVID from Brisbane here, which was wonderful. I had a great time, but my domicile hadn't changed. Why? Because we still had the family residence, the dog, the businesses, employee, all sorts of things that tied me back to the US. But when we moved in January of this year, different story. The domicile was changing. The dog had died, sadly. We sold our house. Various other things were tied up and finalized, completed. And so we moved to Australia. And so I'm now an Australian domiciliary outside of the US tax system. So for gift and estate taxes, domicile is what matters. This has particular relevance to non-US people. To US people, I'm afraid, unfortunately, there's not much we can do here because you're a US citizen or a permanent resident, you're taxed everywhere and everything, so it doesn't really matter. But if you're an Australian, especially a returned Australian who still has US situs assets, then pay attention because this is going to be of particular relevance to you. Okay, and the last bullet point is what matters here. The returned Australians, or they could actually be from anywhere, but we're talking about Aussies, obviously. You're only taxed for transfer taxes, gift and estate, on what's called US situs assets. Situs there is italicized because it's Latin. Let's talk about what are US situs assets. Well, certainly, and this is not on the slide, so looking at me, everyone, tangible property, physical property. If you own real estate in the US, or you have collectibles, artwork, or jewelry, or goodness knows what sitting in your bank vault, then that is considered US situs. Pretty clear. I think everyone gets it. It is tangible. It has mass. It has a weight. Intangible, however, is wild. Like when these laws were written, I don't think they had fathomed certain developments that would later come. So, of the intangible property types, what is a US situs asset? Stock of a US company. Okay, you own Google stock. That's a US, and you're back in Australia. Congratulations, that's a US situs asset. Private debt issued by corporations. Well, that's interesting. Okay, cash value of a US life insurance policy. Don't get confused. That's different from the death benefit. The cash value is not something that Australian insurance policies have any longer. That went away in the 1980s. But US insurance policies can have this investment component to them that grows tax-free. I never really talk about that, and the reason why is because the particular strategy to do with cash value life insurance, which is, it's pretty slick and it works in some countries, does not work in Australia because Australia has what's called principles-based taxation. They see straight through it. They know what it is. It's kind of a tax dodge, and so it doesn't work. So why bring up something that doesn't work for any of my clients? Money market funds or cash at a brokerage firm. This just defies logic, because look at this, cash at a brokerage firm. If you had cash in your checking or savings account or in a CD, that's not US situs. But if it's held at a brokerage firm, bad news. That's magically just became US situs. Business investment assets used for US business. Well, I get that. I think that's pretty clear. Annuities are considered US situs. Okay. Qualified retirement plans, so your 401ks, your IRAs, that kind of thing, US situs. So who does this apply to? This particularly applies to your non-resident aliens. So your returned Australians that either gave up their green card, surrendered their US citizenship, or are only ever in the US on a temporary visa of some kind or other. That's who this applies to. And remember, as the laws are written today, you've got to have an estate worth $13.96 million before you have to worry about estate taxes in the first place. So it's a pretty high net worth issue to have. Let's look at these non-US situs assets, because this is where we're going to get the cogs turning, and people are going to begin to think about, oh, what might I hold in the US and is not considered US situs? Well, firstly, US cited ADRs, that's American Depository Receipts. It's basically stocks of foreign companies that are listed in the US. And there's plenty of them. ResMed seems to come to mind, that has ADRs. I believe Commonwealth Bank also does as well. So you can actually buy it in the US, but it's listed, its primary listing is in another country. It makes sense to me. Why would it be US situs if it's kind of a look through to a different country? Here's one, like I said, that would boggle the best of minds. Cash and demand deposits held in checking or savings. Move it into your brokerage firm, suddenly it became US situs. Keep it at your bank, and it's not US situs. Publicly traded bonds, really weird. Yet again, why is private debt issued by a corporation US situs and Publicly traded is not. I don't know, but that's how it works. Death benefit of a US life insurance policy. We're going to come back to that. That's very important. That's where an Arete comes in and why that makes a ton of sense. It's also one of the reasons why I've been a big advocate for many years. If your situation warrants, get your life insurance in the US. It's not considered a US size asset. The death benefit is tax-free. It's way cheaper than Australian life insurance. There's a lot going for it. And of course, offshore mutual funds make sense, right? If it's kind of under the same category as the first bullet point there. Okay, so gift and estate tax treatment for gift tax purposes. Every year you can give away, a US tax resident can give away $19,000 to whoever they want. And there's no gift tax threshold, gift tax return that needs to be filed with that. So that's good news. So and remember, with a couple, you've got two people. So if a couple wanted to be helping out their son or daughter, they could be making $19,000 each, so $38,000 going to that one kid. Australia is very clever with how it positions its quote unquote gift tax system. There's no gift tax per se, but they're very clever. As I said, what do? They settle every gift back to either cash or it does not get a step up in basis. So if someone's generous and gives you their low basis Google stock, for instance, well, don't look that gift horse in the mouth, because if that low basis US stock was given to you, you inherit that low basis asset. So you're going to be paying capital gains on that when you eventually sell it. More commonly, what we see, however, is that an asset that is gifted is reduced to cash. So someone has to pay tax to get it to cash in the first place, and then the cash is gifted. So the ATO's not silly. They're not losing out. They get brownie points for saying that they have no gift tax, but in actual fact, they're getting their cut no matter what. Lifetime gift tax exemption. It's actually the same. It's called a unified gift and estate. Unified tax credit, so gift and estate. So you can either give away 13.99 million during your life, and then when you die, if you have anything at all left over, it's going to get hit with estate tax. Or you do what 99.9% recurring of the population do, and that is they don't give it away during their lifetime, and then if they die and they have an estate worth more than that, then the estate tax applies only to the amount above the 13.99. Cross-border considerations. US estate tax applies to worldwide assets of US citizens and permanent residents. That's written in invisible pixels after that, and permanent residents. Special provisions may. Now let's talk about what about the Aussie who goes to the US on an E3 visa or an L1 or O1 or whatever, and works in the US and extends that visa again and again. Let's say they kept their primary residence back in Australia, their families all back in Australia, they're registered. Well, that's silly. Never mind that. I was going to say registered to vote in Australia. Well, you have to be, because you're going to get fined if you're not. They have a bunch of facts and circumstances that point to their time in the US only ever being temporary. And one of the most compelling facts in that fact pattern would be the fact that they're on a temporary visa in the first place. What would their estate tax treatment be? They would not be considered US domiciliaries, right? Because they don't intend on staying in the US. They would still be US income tax residents, but for estate and gift tax purposes, they would not be considered US estate tax residents. However, Australia's been a very loyal ally to the US for the past 100 and what are we up to? 110 years. And so Australia has the knockout combo of treaties. We've got an income tax treaty, an estate tax treaty, and a social security tax treaty known as the totalization agreement. So we'll take a look at that and see how that applies. So these treaties you see signed in 1953, shortly after World War II. Australian residents receive proportional exemption based on the US assets and worldwide assets. So Here's an example. You've got your Aussie resident dying, owning a $1 million property in the US, $4 million of total worldwide assets. So the other 3 million are in Australia, for instance. Without that treaty, and I don't talk about this much, by the way, this is something that many of you, I'm sure, have been confused by and encountered before. People say, oh, no, that's whoever this guy is you're listening to on YouTube. He's wrong. There's only a $60,000 estate tax exemption for non-resident aliens in the US. Well, that's true if you don't have an estate tax treaty. So Australia does. That's why I never talk about it, because it's the general rule for countries that don't have an estate tax treaty. Australia does, so it doesn't really come into it. Well, bad news for that non-resident alien without the tax treaty, who's in whatever country that does not have one. And there aren't that many of these estate tax treaties actually out there. Unlike income tax, where I think it's up to 78. I think estate tax, it's only like 18, if I recall correctly. So this individual would get hit with a 40% estate tax on $940,000. Ouch, that is going to really, really hurt. Compared with the treaty, where we see it's 1 million of their 4 million is exempt. Well, there's a formula, so 25% of their assets times the 14 million exemption. $3.5 million is what they're exempted. They've got $1 million in the US, so no US estate tax is due. Remember, proper documentation needs to be filed. This is one of those areas where the professionals really do have a positive ROI. If you're dead, you might not be around to see the impact of that, but no doubt there is a positive return on investment actually having the proper paperwork filed. Current high exemption scheduled to sunset after 2025. That's true. That's why I began talking about the status of tax negotiations, because technically the estate tax is set to revert, but I just can't imagine that it's not going to be extended, given the priority that the Republicans have on that. Consider ownership structures to minimize US estate tax exposure. Well, this is a gift to all those that are here. You might think about, if you do have and this is unbelievable. This is how the tax rules are written, but it's how they're written. You can actually put intangible assets like real estate into an intangible vehicle, like some sort of LLC, for instance, and magically you've just turned your Californian, your $1 million or multi-million-dollar California residence or investment property into a non-US status asset, which is a miracle. But again, you wouldn't know about it if you didn't attend these kinds of webinars and educate yourself. So good for you for being here today. Okay, so what do we have here? Pitfalls of Australian testamentary trusts on the internal US tax code. What on earth am I talking about here? Australian testamentary trust. A testamentary trust is a trust that springs into existence when the grantor dies. When someone dies and they have a testamentary trust, then magically this trust springs into existence and their assets flow into it. Well, not so fast if there's a US connection here. Why? Because, not surprisingly, an Australian trust would typically fail the two tests that the US have. Is the trust administered by a US court? No, because it's an Australian trust. And are the trustees US individuals? Also, well, maybe, but you have to have both tests pass for it to be considered a US trust. So suddenly we've got a foreign trust, and this triggers complex tax reporting on Form 3520s, possibly amongst others, for the US beneficiaries. So no bueno there. Grantor trust exposure. US beneficiaries with appointment or veto powers may be deemed owners, and thus grantors under Internal Revenue Code Section 678, taxing global trust income, even without distributions. Now, people would say, oh, that's not so bad to tax the distributions. Fair, okay, that's fine. You make money, you pay tax. It's a good problem to have. But if it's not even distributed, then it creates problems such as what is currently being discussed. Labor, who just got back in, slight change of topic, but the principle is the same. So Labor, who just got voted back in, they're talking about introducing this $3 million cap to superannuation accounts, after which you get hit with an additional 15% tax. Well, we're not here to debate the merits of that, but one specific thing about that I see as problematic is those gains that occur above that $3 million level, they're not paid. The tax that's due is not paid from superannuation. So you may have, and this not surprisingly, you get farmers that have very illiquid land holdings, and they've got their self-managed super fund that owns a bunch of land. Well, it gets to be above that $3 million threshold. If it is assessed to have grown in value, then suddenly they get this big tax bill that they have no liquidity to pay. It would seem fairly simple in my estimation to have an accrued tax liability, so it's not due in the current year, but it's attached to the property, but that's not how the law is written. So there's a problem there where you've got tax owing and you don't have the matching liquidity from the sale of the asset to pay that tax. Double taxation traps, we don't like those. Capital gains distributed to US beneficiaries face 30% withholding in Australia, plus US income tax as well. So no treaty relief for trusts. That's bad news. We really don't like that. I'm not familiar with this Greensill ruling. I do know who Greensill is. He was a gentleman from Bundaberg who went to the UK, has been embroiled in tax controversy over there. I'd have to look that up again. I'm sure someone will write in and say Greensill was blah blah blah, is doing something a little on the fringes, and then the investment vehicle structure that he was promoting went belly up, and he ended up owing a whole bunch of tax that he has no way of paying. Control risks. A sole trustee or appointer authority by US persons triggers grantor trust status, nullifying the tax deferral benefits. Okay, so yet again, why we don't want this. And state tax surprises. And they're not pleasant surprises, not like a trick or treat. This is getting hit with, as you heard me say before, if you're considered a domicile of California, well, congratulations, you get to pay California tax as well. So not very pleasant. I think if I took an audience poll right now and I said, who here thinks that having US beneficiaries of an Australian testamentary trust is a good idea, there would probably be no one saying yay. Further problems, post-death complexity, okay, blah, blah, blah. I think the point's been made well enough. There are mitigation strategies. Use joint appointers, trustees to avoid self-control. Yes, okay, this is yet again where you're going to be dealing with the right cross-border estate and tax counsel who knows about these sorts of things. Structured distributions as loans, that gets around the distributions, obviously, because it wasn't a distribution, it was a loan. Explore US compliant testamentary trust alternatives pre-migration. There is teeing up a referral right there to an estate tax lawyer who does cross-border work. Sadly, there's only a few of them. So that's the situation we have today. Moving on, wealth preservation techniques. I'm going to talk about two in particular, and that's ILITs, because we love our four-letter acronyms, ILITs and GRATs. So irrevocable life insurance trust and grantor retained annuity trust. Pretty advanced stuff. I would say this is probably the most arcane or obscure financial planning topic that I've ever covered in my material. And you'll be hard pressed, I would imagine, to find much information out there on YouTube talking about this kind of thing. So what is an ILIT, and for whom would this be relevant? An ILIT is an irrevocable life insurance trust. I'm sure we all know, each one of those words is English, but what does it actually mean when taken together? It essentially means, let's look at this diagram here. It essentially means you've got a grantor who creates a trust and then makes a gift of funds to pay the premium. Ideally, it's a couple. What did we see before? How much could they gift? to that trust, $38,000, $19,000 a year, without it triggering present gift tax returns. So they can make a gift of up to $19,000, $38,000 a couple to this trust. There's a more complicated thing called a crummy trust, which doesn't mean it's bad or deficient in any way. It's just the name of the particular case law from the 1960s. Mr. Crummy, who took this case to the tax court and was the guy that resulted in this thing called crummy provisions coming into place, where the beneficiaries can decline to accept the gift, and it goes to pay insurance premiums on a permanent life insurance policy. So then the money, long-winded way of saying, grantor makes gift to trust pays premium to life insurance company issues a big fat insurance policy. At death, what happens here, this is taken from Transamerica, hence why we have a nice little outline of their building in San Francisco. They pay the death benefit back to the trust, and the trust then pays distributions to the beneficiaries. Well, why would you do this? And those folks here on today's webinar that are paying particularly close attention would probably be thinking of this. What is not a US situs asset? Death benefit of a US life insurance policy, correct, exactly. So this suddenly has a lot more relevance to high net worth folks who, and if you weren't a US person worried about estate taxes, you wanted to create liquidity to even out an estate, let's say, that's probably a better example, more broadly applicable to many, many more clients or individuals on today's call. If you had a lumpy estate that wasn't going to divide nice and evenly between your heirs, then something like this could come into it. So you have an ILIT where it's going to pay a couple million in death benefit. Therefore, Josie, she gets the house that's worth $3 million. Maybe that's all the estate's worth. You can't divide a house in two. So Josie gets that, and Betty gets the $3 million from the ILIT. So they're both made whole, and that's how it was done, was by funding an ILIT. Key benefits, estate tax minimization. So the insurance proceeds are excluded from US taxable estate. Why? Because it's an irrevocable trust. Again, Australia sees through that. They say, listen, guys, we understand what you're trying to do here. We don't buy it. An irrevocable trust is not necessarily going to pass muster on the Australian side. But in the US, you can say, hey, it's not mine. I gave it away. I'm just funding this thing that by chance happens to be paying me and paying my heirs and this trust that I set up and structured to be exactly what I wanted. But it's not mine, so don't tax me on it when I pass away. Asset protection, that's great. So shields from creditors and legal claims. You can, of course, customize the language used in that trust document to go to who you want it to go to, when you want it to go to, and for what particular purposes. And it may also preserve government benefits. So that's especially useful in the example of special needs children or those with other issues such as addiction, for instance. Okay, we just saw this a minute ago. So applicability for Australian-based clients. So if you've got US tax exposure because you're a dual citizen, this could be helpful to pay that estate tax and not have to sell the primary assets within the estate. But do note that the Australian tax planning laws differ. Irrevocable trusts are recognized and used for asset protection and tax planning, but local tax implications compliance must be considered. Yet again, this tees up a referral to our friendly US-Australia estate and tax attorneys. And of course, well, the third bullet point is saying really the same thing. Once assets are transferred, you relinquish all control. You know, seemingly there's this thing, a very, very advanced estate planning topic known as decanting a trust. I don't know a lot about it, but it's essentially a way of controlling even an irrevocable trust. So that's to say that not all of those strings that the master of puppets have been dropped. So there may still be some things that can be done. Seek professional legal and tax advice. Really, all I'm able to do here is to tell you that such strategies exist. It's up to you to use your imagination to think about how they may apply to your circumstance. Next is a grantor retained annuity trust. I am excited to share this with you because it is really wild. It is very advanced, and I get a particular thrill out of working with entrepreneurs and business owners. And this is a strategy that really can make sense for the younger business owner who's on a much higher net worth trajectory over time. So a grant is an irrevocable trust designed to transfer appreciating assets to heirs with minimal estate and gift. How does this work exactly? Well, what you do, and I've got a diagram here. What happens is this: the grantor sends over the property, transfers, not gifts, transfers over this property to the grant. The grant then must pay back an annuity stream, which need not be cash. It could be shares in the very company that they just transferred over. And then at the end of the term, whatever difference that the growth that was achieved above a certain interest rate within this grant is then able to go to the beneficiaries that the grantor named in the grant in the first place. So let's walk through that a little bit slowly, little bit slower. So the grantor has shares in a pre-IPO company, let's say. They say, I'm going to gift a million shares in this company to the grant. Why am I doing that? Because I think this company is going to do very well. I think its growth trajectory is fantastic, and it's going to be worth millions of dollars or hundreds of millions of dollars in the long term. So that's what I'm going to do. However, that grant needs to pay me back in order to zero out the gift. It needs to pay me back the initial value of the gift that was given to the grant, plus a small interest rate. That interest rate, as of today, is about 5%. So it's going to give back to you the principal plus 5%. So if you're gifting pre-IPO shares in a company that's growing at 20%, then you're beginning to see the value of the grant. The difference between the Section 7502 interest rate, which is 5%, and 20%, you're seeing 15% of this total growth is able to be captured in the grant and then sent to the next generation. So that's, I hope that, I said seven, I misstated, sorry, the Internal Revenue Code section 7520 rate. So how does it work? Let's talk through that. The grantor receives fixed annuity payments from the trust for a set period, minimum of 2 years, typically not 10. If the grantor dies in the middle of the grant, then it gets unwound, so we don't want it to be too long. The real magic of a grant is when the annuity payment that's received back zeroes out the initial gift, thus no gift was considered to have been made at all. And what's happened is you froze the value of the property, the value of the assets transferred to the grant at the time of the transfer, and any subsequent growth is captured within that grant and then sent to the next generation. If the assets appreciate above that rate there, the 5%, it was lower last couple of years when interest rates were near zero. It was 1.2. It was very, very low indeed, which made this estate planning strategy a lot more attractive at that time. The people were doing it more frequently, say around 2020, 2021. Okay, to whom is it suited? Clients with appreciating assets who are risk averse, and/or clients who have used up a majority of their exemption and wish to do more gifting. This is what I was saying a minute ago. It was popular several years ago, but now with 5%, it's not quite as attractive, but it could still be beneficial to the right type of situation. So what assets are suited? High growth or high income assets. Your hurdle rate, remember, is 5%. So the assets could be publicly traded stocks, startup or pre-IPO companies, closely held businesses, especially if discounts are available. If you use some sort of illiquidity discount, a control discount, something like that to reduce that value, then that could be especially helpful. Commercial real estate with high growth potential, basically any asset with high growth or income potential. The goal is simply to outperform the hurdle rate, and the more you outperform it, the more you're able to send to the next generation without fear of estate or gift taxes. This is really important. I got stuck on this concept for a long time because it just didn't quite make sense to me how these things work. But now I think I finally understand them. So the payment form, it doesn't have to be cash, and that's what confused me was if you're giving shares in a pre-IPO company that's not paying a dividend, it's not liquid, there's no dividend. How on earth is this GRAT paying the grantor an annuity back? Well, the way it's doing it is the stock itself, if it doesn't have the cash to make the payment. So the difference then is the value of the stock at the time it was gifted and the value of the stock at the time the annuity payment is due is the difference. And what can remain in the GRAT is the growth of that share. So maybe a split would be in order, or there would have to be some minimum number of shares available in order to equalize between what can stay in the GRAT and what would have to get paid back. Okay. No downside risk, minimal downside risk. If assets underperform the 720 rate, they achieve less than 5%. The grantor simply recovers their initial contribution. I think the risk is the time and money involved in setting up the GRAT in the first place. Considerations for Australian-based clients. So useful for Aussies with US estate tax exposure. Of course, any type of Australian tax resident or high net worth, ultra high net worth individual who's going to have US estate tax problems by virtue of the value of the assets they have there. There's complex structuring and strict compliance with US tax rules involved. And if the grantor dies during the term, the remaining assets revert to the estate, which may be subject to US estate tax. So here's an example of a GRAT in action. Mr. Carter here is a dual Australian-US tax resident. He owns 1 million shares in TechCo, valued at $10 million. He expects TechCo shares to appreciate significantly ahead of a planned IPO. Great. So he transfers half of his TechCo shares into a 5-year GRAT. How much is that GRAT due to pay him? It's going to pay him back $2.2 million a year. Why 2.2? Because there's your 4% increase over and above the 10 million divided by 5-year period. So would otherwise be 2 million, but we're adding a tiny bit of interest on here. So if TechCo were to appreciate in value by more than 4% in the case of this example, then that amount that is more than 4% is what would stay in the GRAT and then pass to the next generation. So good news for James and his heirs. TechCo shares grow at 12%, reaching $17.6 million by the end of the GRAT term. The IRS assumed interest rate would have resulted in a $12.2 million annuity payment back to James. So that's why his gift was zeroed out, which means that $5.4 million of growth passes to the heirs, gift and estate tax-free. That's what a GRAT is, folks. It's also, I should mention, very high on the list when the Democrats are in power to get rid of. They don't like it. I remember hearing about it just in the last administration that this was in their sights. Who knows? Some backdoor dealing, some lobbyists got involved and it went away. So it's still on the books, meaning the proposal to get rid of it went away. The GRATs are still on the books. So cross-border implications. While the GRAT is a US trust, Australia may tax beneficiaries on distributions of their Australian tax residents. Thus, proactive structuring, distributing appreciated shares rather than cash can defer Australian capital gains tax until sale. Okay. Again, Australia doesn't miss out, though. They say, no, there's no step up in basis. We don't do that. That's a US concept. We're going to tax you on the original basis of that share. So the ATO is not missing out. The GRAT has got to adhere to US anti-abuse rules and Australian trust reporting requirements. So plenty of compliance there. Again, why you want to be using appropriate tax counsel on this. So the key benefit, obviously, is James was able to transfer $5.4 million to the next generation. Dual citizens must ensure that GRATs do not inadvertently trigger Australian tax residency for the trust or conflict with local inheritance laws. Talk to your professionals. All right, folks. So That is it in terms of content for today. Running very much on time. I'm pleased to share. If you'd like access to further content, you can go to our client, our website. Click on Client Portal. If you're interested or you feel that we might be the appropriate firm given your circumstances, then click on Get Started here. We can find a time to chat. In June, it's going to be a different time, I might add. In June, we're going to, so never mind, it says 5:30 p.m. It's usual time, but that's actually exactly when I'm going to be arriving in the US for a couple of weeks. So I'm going to be kind of tired from having been up all day. But my wife Eliza and I are going to be doing our 6th installment, just reflecting back on the lessons learned in moving between the two countries, this time back for good. And what have we found in terms of dealing with moving companies, changing of tax residency, redoing estate planning documents, et cetera, et cetera. So that's what we have for you coming up next month. I hope you can join us. Any questions, concerns, or doubtful points? I would love to address those now. I see in the chat, Nancy. Thank you, Nancy. Fantastic presentation. It really resonated with me since I'm closer to. Good for you. I'm looking forward to having you back here. Any other questions, concerns, doubtful points, or stories anyone on today's call would like to share? Now would be the time. Good to see some clients and friends of Areté on today's call. When I'm doing the presentation, I can't actually see what appears in the Q&A session or the attendees list. I am going to guess that everyone's head is spinning from the complexity of the content. Hi, Jim. I'm guessing you've got a comment to come. So I'll give you a second to type that out, assuming I'm reading you right there and just getting that out first of all. Thank you, Beth. You're most welcome. Not seeing any. Oh, okay. I see. Just saying hi. Well, good. I hope you're well, enjoying South Australia, and soon to be joined by another client of mine who was on this presentation a little bit earlier. Thank you so much, and I look forward to hopefully catching up with you again next month. All right. Have a good day. Bye-bye.